Disney has been one of the most weird stocks to own during the pandemic, as they have been able to restructure their business to continue growing. Hello everyone, welcome back to the channel. Today we are going to talk about Disney, their valuation, their earnings, everything. Disclosure here, I do invest in Disney stock. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. Also, I have a completely free Discord group chat, which the link for that is down in the description below. So basically, Disney was certainly a company that got affected a lot by the pandemic, as all theme parks, cruises, and experiences that they offer remained closed for a very long period of time. But it also demonstrates that it is one of those companies worth investing in, as they were able to surpass that pandemic crisis without going bankrupt. What impresses many or scares others investors out is that the stock is up 20% since its pre-pandemic levels, but their revenue is nowhere near that. Still, they announced their Q3 2021 earnings, and let me tell you that it is excellent. They delivered very nice numbers, and the stock popped 6% after those earnings report. But many are concerned that everyone is very excited about streaming, which might be the reason of why the stock has gone up that much. But let's check those numbers first, and then I'll give you guys my final thoughts on all this. They reported a total revenue of $17.02 billion last quarter, which obviously is an excellent growth year over year, but they are not at pre-pandemic levels, as they reported $20.2 billion in Q3 2019. But we know that even though their parks are open again, they are at limited capacity in comparison to 2019. Still, we can see here that their Disney media and entertainment have increased 18% year over year, but the best part is that their Disney parks, experiences, and products grew way over 100%. But not only that, they returned to profitability after 4 consecutive money-losing quarters. Many think that the availability of the vaccine prompted families to return in large numbers to Disney World and Disneyland as they reopened this year after being closed for 14 months. Now, something very interesting is that their direct-to-consumer, which is all their Disney Plus, Hulu, ESPN Plus, and all that, was $4.2 billion, which is a 57% growth year over year, and it is certainly higher than what it was in 2019, as they didn't have Disney Plus at the moment, which is obviously a good sign. Now, member-wise, Disney Plus grew massively year over year to 116 million members, while analysts were expecting 112 to 115 million members. Also, even though not many people talk about ESPN Plus, it is a part of their premium package, and it grew 75% year over year, while Hulu 21% or so. Nothing in comparison to the others, but still very nice. Because to be honest, Hulu is not as huge as the rest, as I think people prefer Netflix. Correct me if I'm wrong, but I do. I have Disney Plus and I have Netflix, but only used Hulu once when Spotify was giving a year free of Hulu subscription, and you take advantage of everything that is free, right? Now, something that many did not like was that their average monthly revenue per user decreased 10%, while the others did increase. Many believe that Disney Plus have a limit, and that once they reach that limit, subscribers growth, the growth will stop, as their ARPU is very low in comparison to Netflix, which is $9. I was watching CNBC, and Kevin O'Leary explained something very interesting here.
I do own it, and I disagree, and I'll tell you why. The criticism on Disney and why you sell here would be around ARPU. In other words, all the excitement, as John pointed out, came from the fact that they actually executed well on becoming, let's call them, the second biggest streamer in the US. But they don't get anywhere near $9.75 revenue per user. They're like at $4, because all of their growth is happening in places like India, where it's 50 cents a user. So now my question to the new team, which they got plenty of, was, how are you going to build ARPU? How are you going to get to compete with Netflix, where they're making $9 plus, $10 even, when you're at $4 and change? And their answer was, and this is where you got to make your decision as an investor, we're investing in expanding our share. You get in cheap into Disney, even in their premium ESPN Hulu bundle, and just let us stew that for a while. Give us an Amazon-like vibe. Let us grow without the necessary profits that we could have had until we establish ourselves as a dominant or right beside Netflix. Then we pull the lever on price increases.
Basically, what he said is that Disney will gain market share being cheap because the biggest one worldwide is Netflix, then Amazon Prime, and then we see Disney Plus. So basically, they want to continue growing their subscribers count until they are at least the second biggest one, or when they max out to start increasing their prices. And I think it is a very nice strategy, but it's a long-term strategy as long as they continue having a good content, because if they increase prices but don't come out with good content, bye-bye. Many will cancel their subscription. Now, they do have plenty of cash on hand to pay all the current liabilities. They have $33.9 billion in total current assets and only $27 billion current liabilities. Having a healthy balance sheet is what helped them throughout the pandemic. Still, we all know that if they were to need cash, it was going to be easy for them to raise capital. They have so many brands, huge brands, that they are able to raise capital whenever they want when in a storm like the pandemic. Now, something very important as well is their free cash flow. I think it is even more important than profitability, as net income can get affected by all of those accounting rules and all that, but free cash flow is harder to manipulate as it is basically cash from operations minus capital expenditure. They reported cash provided from operation of $2.9 billion, which is a huge decrease of $3 billion, and ended with free cash flow of $466 million only. They did mention that the decrease in cash provided by operation was due to higher spending for film and television content and lower segment operating results, taking into consideration that this free cash flow is for the past 9 months, not last quarter. If you ask me, they reported excellent numbers, especially from their streaming service, which I think is what has helped the stock go up so much the past year. I think everybody is so excited about streaming that has made the stock go up this much, because if we check the chart 5 years ago, the stock was going up, yes, but more of a steady growth in the past 5 years. And even though the business got really affected during the pandemic, the stocks still have recovered nicely, way better than cruise line stocks or theme parks like Six Flags. I'm comparing it with them because Disney have theme parks and cruises, which is what confirms that them entering to the streaming industry have helped tremendously the company. Maybe converting it into an overvalued stock? What do you guys think about that? The stock is currently trading at $180 per share with a market cap of $327 billion for a P of 35 and a price to sales ratio of 5.15. Analysts are expecting this stock to go up 27% or go down 18%. I do understand that Disney expanding to streaming is their major growth driver over the long term, and their focus on sports streaming with ESPN Plus is expected to drive growth in the long term as well. Obviously, the reopening of theme parks have helped with the growth to almost pre-pandemic levels, but we gotta keep in mind that COVID variants are hitting hard as well, and that could easily affect them again, as we saw with Airbnb, how they said that cancellations numbers are rising and booking numbers are decreasing because of the Delta variant. Well, obviously Disney will get affected as well, and even more after we saw this morning that McDonald's and others are considering closing indoor seating again because of the Delta variant. Still, I've been investing in this company since November 2019. I saw everything with Disney Plus and thought it was incredible, as the streaming industry has been popping lately, and Disney already had a huge portfolio of content already that was obviously going to attract a lot of people. Right now, this stock only represents 1.88% of my portfolio. I know I should have added more, but you know how it is. I like to add in small portions of money and not everything at once, and the stock went up really fast. My average cost is $123.20 per share, since I'm up almost 45% in my position, and even though it represents so little in my portfolio, I'm not planning on selling this stock. I'm actually planning on adding more to it as the company keeps growing, but I believe it is a little expensive right now. I would wait until a dip to happen before adding to my position. I'm planning on holding it long term. This company just showed us that by innovating like they did with Disney Plus, they were able to see growth and sustain during the pandemic. If not, I think they would have survived, as they had a nice balance sheet and it was going to be easy for them to raise capital. But surely entering the streaming industry with Disney Plus has been one of the best decisions they have made, in my opinion, and which is why the stock has gone up that much, because now everyone is just waiting every single quarter to know how many subscribers they have. The management team have done a phenomenal job, in my opinion, restructuring the business due to the pandemic, and I believe in the long term it will get way better. Still, I believe the stock is a little bit high right now. Maybe if it kind of stays around this price while fundamentals keeps increasing, we see before the pandemic numbers and growth once again, it could make sense for me to invest at this current numbers. If not, I will wait it to drop maybe below 170 or even $150 per share. Now, are you investing in Disney stock? Hope you enjoyed the video. Please smash that like button and subscribe, since it really helps the channel out. Remember about the completely free Discord group chat. Which link for that is down in the description below. Thank you and see you next time.